All right, hey, welcome back to Principles Accounting 1. We are in our very last session together, believe it or not, for the fall 25 semester. Yay! We we made it to the end. Um, okay, so there's two chapters we're going to get through today. This first one is on investments. The next one's on the statement of cash flows. Relatively shorter chapters, which is why we grouped them together in the final week. They're both important. That's why I want to make sure that we cover them. So first we'll talk about investments, then we'll jump into the statement of cash flows. Real quick, just want to bring your attention to the classroom. We are sitting here in week 15 of the semester. Today is the 4th. The week ends on well, technically speaking, the week ends on the 7th, but you'll notice I have extended out to the 9th. That is because I believe, and correct me if I'm wrong, our semester technically ends on the 9th. So what I did is I wanted to make sure that you had enough time to get everything done. So I extended everything to the 9th, just to make things a little easier for yourself. And I have this currently scheduled the final exam on the 11th. So what I'd like to do tonight is I'm going to cover chapters 15 and 16. But you have a lot of action items to complete for this coming ninth, this coming Tuesday. So there's really three action items that you have left for this course. You have a financial statement analysis LinkedIn certificate and the quiz for chapters 15 and 16. So three action items. I'd like you to try to get these done by Sunday, just so that way you don't have to be stressing, and then roll into the final. Yeah. So definitely work ahead, so that way you're not stressed out at the end. Okay, so let me go ahead and jump into our first discussion on investments. So we're going to talk about investments from a corporate perspective, not so much a personal perspective, but they do work pretty similarly, and I'll explain why. Companies need to be able to raise cash to sustain the business, and really, there's only two ways to do that. One is by debt, and the other one is equity. Now, companies also invest uh, in both debt and equity. And I'm going to explain the differences between those two types of investments uh, uh, because I think it's really important to understand that. And I'll also explain to you, um, how the trading works and all those types of things. I'm going to really touch on the important stuff that I think you should know as a manager. So first, once you get out of the thought of debt as being something that somebody borrows, and more into the thought of debt as uh, what somebody might purchase from somebody else to earn interest income. All right. So, a couple of reasons why businesses would invest in other businesses or in individuals. First and foremost, obviously, companies want to generate extra cash. And so, if they have extra cash laying around, they'll use that to help to generate additional income. And so, the company will take their extra cash and invest that into, let's say, stocks or bonds in another company. And that is a way for the company to generate extra income. Uh, They might also invest in a company for more strategic reasons. I'm going to give you a really classic example of this. A long time ago, when I was working with Starbucks, Starbucks uh, invested in this company called Peet's Coffee Shop. And some of you may be aware of the brand. So what happened is that Starbucks saw this smaller chain of coffee shops out on the East Coast called Peet's Coffee, And they're like, hey, this would be a good investment for us. They kind of do the same type of work that we do. We know the business. Let's invest. So Starbucks purchased about 5% of shares of stock into Peet's Coffee. And, the stock did pretty well. And Starbucks is like, hey, you know what? Uh, it's a good investment. So Peet's began to grow like a lot. They got up to the same size as Starbucks. So Peet's Coffee and Starbucks basically became about the same size. And then Starbucks was like, we kind of see them as a competitor now than we did before. So now they're like, you know what? We're going to invest for strategic reasons. So they purchased another 5% of shares of stock in the Peet's Coffee. Now they own 10%, and then 15%, and then 20%. You sure we're going, right? 30%, 40%, you know, and then eventually they worked their way up to 51% shares of stock in Peet's Coffee. And so what that did is it made Starbucks the owner of Peet's Coffee, right? So that we call that a hostile takeover. And it's a way where companies invest in other companies to hostilely take them over by taking the majority ownership, by buying up all of the available shares outstanding. So that's what happened, and that's one of the motivating factors for businesses investing into other businesses. This chart, this chart here kind of shows you short and long-term investment strategies of other companies. Here we see Apple, they have 9% short-term investments in other companies and 29% investment into other companies, which kind of gives you a picture that Apple is looking to possibly acquire a competitor or maybe a firm that aligns with what it is that they do. We can also see Coca-Cola. They have a 4% stake in short-term investments, and they also have a 20% stake in long-term investments. Now that's interesting. Maybe smaller beverage companies that Coca-Cola is looking to acquire might be within that 20%. And then we see Microsoft, 19% short-term investments, and then they have 2% long-term investments. Well, that could be interesting too. Microsoft tends to make small investments into smaller studios that do software development, and then they'll sell those studios off or spin them off into their own businesses. We saw them do that with Activision Blizzard. So it's a very, very common way of for businesses to make acquisitions or just short-term investments, right? So that's the whole idea behind short-term and long-term investing. In the short term, it typically means that we're holding shares of stock in a company for 1 year or less, and we intend to sell those shares of stock and convert those shares of stock into cash within 1 year or less. That's what makes it a short-term investment. Uh, Long-term investments, these, as the name implies, these are stocks or maybe even bonds that a company will purchase from another company. And the idea here is that the purchasing company is going to hold on to those stocks for longer periods of time, so greater than 1 year. Now, obviously, there's some good and bad things with longer term investments. One is you can't easily sell it and convert it into cash. It takes a little bit longer than that. Uh, and the idea really is more on the strategic side of things when we look at longer term investments. I had mentioned that some companies will purchase bonds in other companies. A bond is a form of a debt security. So the way that bonds work is that it's kind of like I like to think of it as like a private loan, right? So let's say I'm in debt and one of you's has extra cash on hand, and you're like, you know what? I can buy that debt from Dr. B, and Dr. B will pay me back it, uh, in the form of interest until the bond matures, and then I'll receive my balance back. That's a form of a debt, of a bond, right? And so some companies they'll purchase bonds or private loans or certificates of deposit, and it's a form of a secured debt, right? So bonds, certificates of deposits, and private notes are usually issued by governments, companies, and individuals. The other form of security are shares of stock, and those are part of equity, right? And those are typically issued only by companies. So the way that we think about these investments, they're either classified as a debt investment or an equity investment, and it's either going to be short term or long term. With debt investments, these could be what we called held to maturity investments, where we hold on to a bond until it matures, meaning that's when it's due. But we call it held to maturity. Debt investments can also be traded securities. I can buy and sell bonds uh, or certificates of deposit or whatever on an open exchange, right? So that's a trading of a debt security. And I can hold on to a bond and then try to resell that bond. We call it available for sale. Okay. So, so those are debt investments. The other side is we have the equity investments. Now, equity investments, those are shares of stock. If it's a small amount of shares, like let's say 5% of stock outstanding, that's pretty insignificant. You know, it's a small amount, you know, whatever, not a big deal. If it's something like, you know, 20% to 40%, that's pretty significant. That's a significant amount of stock. You know, that gives you a lot of influence over the board of directors on ways that they can take the company, you know. So that's a big shareholder. And then once you reach 50% or more, you own the business. You know, 50% or more ownership in the business. You own that business. You control that business. So that's how percentages of stock works. You know, five anywhere between 1% to 20% is insignificant. 20% to 40%, we'll say maybe 45% is significant. 51% and above, that's controlling. So that's how we identify the different levels of influence when it comes to shareholders. The larger the shareholder, the more significance that they have, and they can influence the business in their decision-making process. We're going to roll through a couple of examples with you um, related to our investments. So, the way that a company would acquire a new investment could either be a bond or a share of stock or whatever. And so here we have an example where uh, a company is investing into Dell Corporation. Okay, so here we have a vendor of Dell's that's purchasing a bond from Dell. the corporation. So it works like this: July 1, 2026, company paid 30,000 bucks. I think that should be 2027. July 1, 2027, company purchases 300,000 $30,000 in a form of a bond from Dell with a 7% interest rate, and the bond is for 2 years. All right. So just like we talked about, I think it was last week. We talked about time value of money. The same application applies to the bonds. So it works like this: the company making the investment, which is Lincoln Company, they would debit debt investments 30,000 and credit cash 30,000. Now, the company Ling will receive interest payments twice per year. Now, because it's 7% interest, semi-annual payments, and it's for 2 years. So every 6 months, there's going to be a transaction where the company is receiving interest from their debt investment. And it would look like this. We take the face value, par value, times the interest rate, 7%, times the amount of time, 6/12 months, every 6 months. And so you multiply those together, you get, in this case, $1,050. So we're going to debit cash 1,050, credit interest revenue 1,050. This represents the interest being received from the investment into the debt. Now, when that bond matures, the company making the investment will receive their principal balance back, or their face value back. So at the end of the bond, when the bond matures, we're going to debit cash 30,000, credit the debt investment 30,000. So that's when the company makes a direct investment in another company's debt. We call that a bond. So that's what a bond is. Now, the cool thing with bonds and other forms of debt is that they can be bought and sold. I can buy a company's bond and then sell that bond on the bond exchange. And so I want to talk to you about how those trades of debt works. So it's a form of what we call trading securities. And these are debt investments that the company intends to actively buy and sell for a profit. That's kind of the idea behind it, is I'm trading a bond for something else, usually cash, right? I'm selling it for cash on an open exchange. The portfolio of trading securities is reported at its fair value and sometimes requires a fair value adjustment accordingly. We look at this as an unrealized gain or loss when there's a change in the value of the security that's being traded. And so I'll give you a couple of examples of that here. So here I have an example where our company has a couple of debt securities in it. We got a portfolio, a couple of different debt securities of $11,500. It currently has a fair value, meaning the market value, of $13,000. So what I need to do is I need to make an adjusting entry to reflect that difference, that $1,500 difference. And so, and it's obviously a gain because on my books I have it sitting at 11,500. It's currently worth 13,000. So that's a gain in the value of the debt that I have in my portfolio. So debit fair value adjustment 1,500 and credit unrealized gain 1,500. All right. Now, when these securities are sold, that difference between the sale price and the fee is called the net proceed. And the cost of the individual security that are recognized as the sale of that security is recorded at either a gain or a loss, depending on if we sold it above or below its fair value. So here we have an example. Our company sells a security that had a cost of $100. We sold it for $120. Okay, great. That's cool. That's a $20 gain. So what we need to do here is we would debit the cash for 120. We would credit the investment $100. That's its face value, and the difference is the $20. So we credit gain on the sale of a debt investment, $20. So that's how selling a debt investment works. Now let's talk about when we would hold a bond until the date that it matures. Or when it matures, that means that's the date that we would receive its fair value at. Or I'm sorry, its face value at. So held to maturity, these are debt securities that we intend and are able to hold until they mature. So I'm going to hold on to it until it matures, because when it matures, I'll get my whole face value back and whatever remaining interest there is. So held to maturity securities are reported as long-term assets on the balance sheet because they extend beyond 1 year. Uh, and so, what do I want to say here? We the held to maturity securities. We usually report these at their what we call their amortized cost. Um, this is similar to the fair value, if you will, for this type of thing. But that you might learn about amortized costs in maybe a finance class or an upper level accounting class. Nothing to worry about today. Uh, the next area of debt is what we call available for sale. Now, this is pretty easy to understand. It's when the debt investment is not classified as held to maturity, but we do intend to sell it at a future date. Now, when we hold something available for sale, we classify this as a short-term investment because we intend to sell it within 12 months or less. If we intend to sell it in greater than 1 year, then it's a long-term investment. Pretty straightforward. We tend to adjust the cost of these available for sale securities to reflect the changes in fair value. So we make adjusting entries to recognize any change in the fair value in comparison to what we have already recorded for it. And then that gain or loss on the available for sale uh, investment, if it's below or above its market value, if it's above, it's a gain. If it's below, it's a loss. So uh, those gains and losses get reported to an area on the income statement called other comprehensive income. So here we have an example where a company had no prior investments. They made an acquisition, or they acquired two available for sale securities on the open exchange. And at the end of the year, the values had changed slightly for each investment. So here we have the two investments. There's Apple bonds and index notes, and we recorded them at their cost. And at the end of the year, we find what their fair value is by looking at the exchanges, and we see slight differences have occurred in each of our investments. So the way that we record this is we take the fair value amount minus its cost. Fair value amount minus its cost. That difference is either going to be a gain or a loss. And so we add up all of our gains and losses and we get our total difference. That total difference is then recorded as a reflection to adjust based at its fair value. So we debit fair value adjustment, in this case $1,500, and then we credit unrealized gain of $1,500. So here we can see uh, what that adjustment looks like on our balance sheet. So we start with our beginning balance available for sale securities under our assets. Then we add in the adjustment, which gives us our ending balance available for sale securities. Very, very simple. Uh, and then that difference, the adjusted amount, also gets applied as an unrealized gain, and that falls within our equity because it eventually rolls up through net income, through that whole process. Yeah. So that's what it looks like from a reporting perspective. Uh, and here we have another example where the company has a portfolio of available for sale securities of 81,000 at a cost and $82,000 fair value. Obviously, the difference here is $1,000, and so uh, and this happened in the following year. So we would take whatever we had from our beginning balance and subtract out that difference. In this case, $1,000 was the change. So that means that the balance would be 550. All right. The next thing I'd like to tell you about with respect to investments is on the equity side of things. We've talked about debt. Now we got to talk about equity. And I want to talk to you once again about how those stocks work. So 0 to 20%. If you own 0 to 20% of any company's outstanding stock, we call that insignificant influence. It's because that 0 to 20%, it's not a whole lot. I can't influence the board of directors by owning 0 to 20% of their shares of stock. However, once we move into 20 to 50%, now we're talking business, okay? Now you're a major shareholder of the company. You can tell the board of directors to do whatever, and a lot of times they'll listen to you because, hey, you own 20 to 50% of the company. That's kind of a big deal. Once you own greater than 50% of the company, you own the company. You are the owner. So you control the company. Now, this is important from an accounting perspective because when one company purchases shares of stock in another, we need to allocate the net income generated by that company that was invested in, depending on the percentage that the company owns. If it's 0 to 20%, we just record whatever dividends and you know whatever else the company throws its way. 20 to 50%, uh, we might be recording some net income based off of the percentage of ownership. 50 to 100%, we're recording all of their net income and rolling it up as other comprehensive income. So it's just kind of how we record the differences. You wouldn't get into something like that unless you were an accounting student and you were getting into, more advanced accounting courses like intermediate one and two, and probably advanced accounting. So let's talk briefly about those insignificant, significant, and controlling type of entries that we would probably make at this level. So here we have insignificant acquisition. Our company purchased shares of stock into a smaller company. We purchased 100 shares for a total of $7,000. We debit stock investment 7,000, credit cash 7,000. Easy transaction. And because we have shares of stock in a company that pays out dividends and it's relatively insignificant, they've decided to pay us some dividends. So nice, nice. We debit cash $10, credit dividend revenue $10. Easy transaction. Now, because we do own, in this example, we do own a decent percentage of shares in the company. Let's say it's close to 20%. We recognize some of that company's net income as an unrealized gain to us. And so we purchased 7,000 shares of stock initially. Over the course of the year, the fair value of those shares of stock went up to $9,000. So we have to make an adjusting entry to realize that unrealized gain to our fair value of 2,000. So we debit fair value adjustment within the stock of 2,000, and we credit unrealized gain 2,000. All right. So just to kind of briefly recap how that works, the unrealized gain or loss is reported as other revenues or gains. This technically rolls up to other comprehensive income on the income statement. And that's where you would see that something like this. But again, when it's insignificant, we're not technically recording a part of the company's income that we invested in. We're just recording the amount that we invested into the company and the changes in the fair value of that investment. Your company might decide, hey, listen, it's time to sell this part of our investment. Yeah, no problem. It's a real simple transaction. We sold some of our stocks on the open exchange. It originally cost us 500. We got $800 for it. Great. So we debit cash 800. We credit the stock investment at its cost, in this case 500, and the difference is the gain on the sale of the stock, $300. Easy, easy transaction. So that's when we have insignificant influence. That's 0 to 20%. What about when we got significant influence? Now we're talking, we can influence the board of directors a little bit. It also implies that the company is entitled to receive a portion of net income from the company that we've invested in. Okay, 20 to 50%. It's based off of the percentage of shares of stock outstanding that we own, and are between 20 and 50%. So let's talk about what that looks like here. Here I have a long-term investment, Micron, and so the company would record Micron purchase shares of stock of Star Company for looks like $70,000. which represents 3,000 shares of the company. The 3,000 shares of the company just so happens to be 30% investment into that company. Now, when you own 30% of a company, you are a significant shareholder. So we make our initial investment, then the year goes on. As the year goes on, at the end of that year, the company we invested in reported net income of $20,000. It's like, great, that's awesome, right? So because, I'm sorry, $20,000. That's awesome. And because we own 30% of that company, that means that we should have earnings of $6,000 from our investment. We take the 20,000 net income from the company we invested in times the 30% of the shares of ownership that we have in the company. That gives us earnings of $6,000. So we would debit early method investment 6,000 and credit earnings from equity method investment 6,000. The company receives dividends also from the percentage of ownership that they have. And because we have 30% ownership in the company said, hey, they're going to pay out $10,000 in total dividends. We own 30% of it. That means we'll receive $3,000. So we debit cash 3,000, credit equity method investment 3,000. Now, we need to understand what the book value of the company looks like that we invested in. And so, in order for us to make this calculation, we take our initial investment plus our share that we've earned from the net income. In this example, it was 30% of whatever that was. So I think 20,000. So we got 6,000 there. That gives us the 76. The company paid us 3, which means we have a remaining balance of 73,000. So it's the investment amount plus the earnings minus any dividends that we've received. And then comes a time where the company says, you know what? We're going to sell our investment. Cool. So they make the sale of all their shares of stock, the 20%, 30% shares of stock that they had. They sold it for 80 grand. Fantastic. That's much above what the investment equity and method investment was, its book value was. So we take what we received, 80,000 minus the book value, 73, gives us a difference of 7, which is the gain on the sale of the investment. So pretty easy calculations. Just wanted to show you what that looks like. And then lastly, along the lines of our equity investing, I want to show you what it looks like with a controlling influence. Now, what I had mentioned earlier is that if the company, if you own 50% or more of a company, you are the owner of that company. You control that company. So any earnings that company earns, their net incomes, that rolls up to your company. So we call this a parent subsidiary relationship. The controlling investor is the parent of the subsidiary, the investee. See, that's how those terms work. So in other words, you own 50% or more of the company, you technically own that company. And so anything that company earns, you earn. It rolls onto your balance sheet and your income statement. We call those subsidiaries. And that's ultimately what happened with Pete's Coffee Shop as it related to Starbucks. They still operate the Pete's Coffee Shop brand, but Starbucks is the parent. Starbucks owns Pete's Coffee Shop. Starbucks is the parent. Pete's Coffee Shop is a subsidiary. This is a nice summary slide. I like this slide a lot. It just kind of gives you a nice recap of everything we talked about with respect to short-term and long-term investments in terms of securities and their effect and how they're reported. If they're reported either at cost or fair value. It's just a nice summary slide to look at. Now, as it relates to those investments on a income statement, you might see this line item called other comprehensive income or just comprehensive income. And so I just want to explain to you the differences between the two. Comprehensive income are all the changes in equity during the period except from the owner's investments and dividends. So we look at comprehensive income and add in other comprehensive income to it, or by subtracting net income out. Now, other comprehensive income, what is it? It includes any unrealized gains or losses from those securities. Yeah. It's typically reported as a separate line item on the income statement as other comprehensive income. That's typically where you would see it. So when it comes to reporting other comprehensive income, it might get reported on its own statement called the Statement of Comprehensive Income, or it'll report it as a line item on the income statement toward the very bottom, and it'll say other comprehensive income. And that's really the difference between the two. All right. And then a couple of ratios that we would calculate. One of those is called the return on total assets. This tells us about how efficient the company is at using all of their assets to generate cash or to generate sales. And so to calculate this, we take the return on the profit margin times the total asset turnover. Now, as you know, profit margin and total asset turnover are also individual ratios. So this is really two ratios to make up a third ratio. The calculations are pretty easy. So for profit margin, it's net income divided by sales. And for total asset turnover, it's net sales divided by average total assets. Now, if you remember a long time ago, you may have learned this in maybe a basic math course, or when we talked about fractions, when you have a like numerator denominator, they cancel each other out. And so in this case, the simplest calculation is we take net income divided by average total assets, and that will give us return on total assets. Now remember, anytime you're computing the average of something in accounting, we take the beginning balance plus the ending balance, and we divide by 2. And this is a nice application of that formula. Here we have Costco and Walmart for simple comparisons. Profit margin times total asset turnover to get the return on total assets. And we can compare Costco to Walmart as a side by side. Just a nice simple way of looking at it. Okay, so that wraps up the discussion on investments. The next discussion that we're going to have tonight is going to be on the statement of cash flows. So just bear with me as I switch gears. I'm going to quickly stop this recording and start a new one. So just hold on.